Well, tonight we're exploring some of the challenges that face the global property market. It's often easier to own a global property fund that's then own direct global property. In such a case, the management of one's funds are done professionally and the fund manager is tasked to own the most opportune assets possible. That's, of course, our topic of the week, and we'll delve into all these questions and how to get exposure to global property through funds here in South Africa. Jamie, I'll start off with you. Just give us a scene setter right now when it comes to how the property market performed in 2012 on a global scale, because by all accounts and purposes, it seems that things are looking up.
Yeah, I mean, 2012 was a very strong year from a return perspective. I think, contrary to what a lot of people might think, the global listed property market, especially at the sort of prime quality asset level, is actually, on the whole, fundamentally pretty strong. And I mean, there are a number of factors leading to this. The biggest thing to my mind is that there really has been no supply brought to market over the last 3-4 years. And there's not a lot of supply coming for what we can see over the next 3-4 years. And as existing landlords, you know, even though tenant demand is not radically strong, in a very low supply environment, fundamentals are on the whole pretty good.
Mm-hmm. If you look at, I mean, just look at kind of house prices in Dubai. They shot up by 20%. We know that market really crashed during the financial crisis, Kwebi. But if you're looking at returns across the board, certainly looking fantastic.
Yeah, I mean, you know, the interesting thing is that when you talk about property, people have this relationship with property much more than they have with equities. Equities are seen as a very volatile asset class and is seen as an asset class that, you know, you only put your surplus money really into, whereas property is always seen as a core holding because of its rental ability and its ability to kind of create this income.
And everyone needs a roof over their head, or businesses need spaces within which to operate.
Yeah, absolutely. And the one thing that I think we're forgetting in the local space at the moment is that an equity or a business can change its business model in order to make more money. A property can't do that. A property rents space. That's in essence what it's about. And the sell down that we saw globally is certainly not something that we've seen in South Africa. And as a matter of fact, just to show you quickly what the sell down looked like, just look at the table that we're putting up for you there. And you could see that, kind of look at the returns from 06 to 2012. And look at some of the big global markets here. You could see some of the negative returns there. Global property down 1.41%, the UK down -14%, Australia, Europe, ex-UK all down over that period. But look at the 2012 returns. If you just look towards the right-hand side of the screen, you can see some of the 2012 returns there. You know, some stupendous returns that you've seen as the market continues to kind of its upward trajectory and as it kind of finds a firm footing, so to speak, again.
Mm-hmm. We talked about the issue around supply, and certainly is an interesting one to bring to bear in terms of how that's going to impact price dynamics. So, Jamie, if you could just go into that for us and talk to us about what you're saying when it comes, why, firstly, we're seeing a lack of supply coming onto the market.
I think obviously during the crisis and the sort of 07 to 09, rents came off radically. So if you look at markets like, I mean, familiar markets that people will know well, London office market, New York office market, rents came off radically. And as a result, the viability of bringing supply to market did not stack up. So when someone's developing out, say, for example, an office building, they will need a certain rental level in order to make the scheme viable. Now, over the last couple of years, rents haven't rebounded enough for schemes to be viable. The other thing is that construction finance just pretty much dried up. I mean, people could not get speculative construction finance. It just wasn't available from the banks. So one of the advantages of the listed property companies is they hold, you know, they don't do a lot of development, but they've also, when they want to develop, they've got their investment property that's got long-term leases underpinning the rental streams there, so they can often gear up on those properties to develop out. Whereas the person who was historically just a pure developer was very hamstrung in what they could actually develop. So both from a viability point of view and from liquidity, from the lending point of view, just meant that there wasn't a great opportunity to develop, and it didn't make financial sense to do it.
Mm-hmm.
Jamie, the supply and demand lag is probably quite important in property. So we have these kind of long cycles where you know, people are trying to buy property, there's not enough, so the suppliers come in by increasing capacity, which takes a while, and then suddenly people don't want the stuff anymore, and then there's oversupply. How long is that sort of lead and lag? And given the sort of chart we've just looked at, we're starting to see supply growth coming through now, well, at least going forward in the next few years. So is this the peak? In other words, from here on, you know, the supply is the scarcest, and then we're going to get oversupply again? I mean, how long do these cycles last for?
Look, supply is increasing a little bit, but it's coming off a very low base. I mean, I think if you look at those supply numbers, you're looking at about 1% of existing stock in the US coming to market each year. Now, obsolescence in the commercial property space is around about that level, if not a little bit higher. So you're actually getting tenantable space contracting to a large extent in a lot of sectors. So to say that there's a lot of supply coming is not necessarily true. I think still for the next 3-4 years we're in a very low supply environment. I mean, the one thing to consider from a long-term point of view, and this is something that we focus on a lot, is when you invest in assets that have very high barrier to entry type assets, it's much more difficult for people to bring supply when the times are good. So when funding's available, when rents are going up and everyone wants to bring supply to market. So you look at a classic example of, say for example, a company like Shaftesbury that owns retail in the West End versus a UK competitor, there's Segro that owns industrial space in the UK and Europe. Shaftesbury, the ability for competitors or Shaftesbury themselves to bring new supply to market is very limited because of the strict controls over bringing supply to that market. Whereas in industrial space, there's a lot more land available. You're generally outside the M25 in London, and being able to bring that supply to market is a lot easier. So over the long term, rental growth for very high barrier to entry markets should be a lot better than markets that can be oversupplied. When times are good.
I mean, Jamie, how do you use that piece of information as an investor who's assessing certain funds then? Because, various funds obviously invest across the board generally. They've got industrial exposure, commercial exposure, and I suppose we'll talk about the Catalyst Fund later on in the show, but how should investors use that piece of information to assess various properties based on that barrier to entry factor?
Okay, sure. I mean, one thing to note, offshore, the guys are generally quite specialized. So they generally focus on a sector and or region. But just to give you an example, if we feel that a high barrier to entry asset has the ability to grow closer to inflation or at a higher rate than low barrier to entry property over the long term, your initial yield that you're willing to purchase that asset or by virtue of that company at can be lower than, say, a lower barrier to entry where you'd want a higher initial yield because your growth is going to be lower over the long term. Does that make sense?
Yeah.
I mean, let's maybe just show you quickly that graph that we put up a little bit earlier on, and this will show you US supply. So now what we're looking at over here is we're looking at new completions as a percentage of existing stock. And just have a look there. That's what Jamie was talking about just now. He was saying that your new completions as a percentage of existing stock is in about 1%. Now, 1985, this was basically as high as 7% and dwindled down to, let's call it 3%. That means the new kind of stock coming online, it's just too little in order to actually sustain the property market. Yeah. The other thing to take into consideration, and we haven't spoken about that yet, is the ability for kind of these REIT businesses, which are the real estate investment trusts, to lend money in order to actually build new properties. And just have a look at this graph quickly, because this one here will indicate to you what, in essence, what their funding costs are. And it's interesting to see that if a REIT had to go and get themselves what's called unsecured debt, that means they go and do their own bond issuance. They can do it basically at 3% at the moment in a global market. But once they start going into more kind of the formalized market, which is either they lend onto their own balance sheet, 4.2%, or the bond market at about 3.9%. Jamie, this must be good news for these guys. I mean, it's not a lot of supply on kind of coming from the financial crisis, but certainly you're seeing that they can lend at decent rates.
Low funding costs are obviously a huge sweet spot for property companies, and actually the trick at the moment is companies that have access to either acquisition pipeline or development pipeline. Look, I said there wasn't a lot of development happening, but in certain nodes it does make sense to develop. And you can purchase / develop properties well in excess of where you can fund them. So from day one, you're being yield accretive, and if you can buy or develop the right quality of assets, which have, from a long-term perspective, have still got good growth in them, you know, it's a great spot for property companies to be in. And I think the one thing about listed property companies is often they have a big cost of capital advantage over, say, private players who aren't rated for corporate debt, et cetera, et cetera. So, yeah, I mean, low supply and low funding costs are two huge ticks for property being in quite a sweet spot.
Do you think that's going to continue, Jamie, in terms of the low interest rate environment? Obviously, that's sort of positive. And have we sort of learned anything from the subprime crisis in terms of people, rating property, maybe, these credit rating agencies, syndication and the sort of approvals of credit ratings that weren't perhaps as transparent as people would like them to have been. Has anything changed on that front, and just on your view on interest rates as well?
Yeah, I mean, just for one, I think pricing on property has not come in relative to what, say, 10-year government bonds have done. So the spread between, say, in the US, where direct property is trading from a cap rate perspective versus where the 10-year government bond is at all-time highs, and in a lot of markets is at all-time highs. So direct property hasn't re-rated because governments are purchasing bonds. So I think from that perspective, there is buffer there for bond yields to move out and for property yields to stay flat. Mm-hmm. The other question on funding rates, I think eventually funding rates have to move out. I think at the moment, you look at your life co's and your pension funds, when your alternative investments are 10-year government bonds sub 2%, if you can purchase debt secured against very good quality assets at reasonably low loan to values at sort of 4.5%, that's reasonably attractive to them given what their alternate is. Obviously, as if their alternate investment, being in this case, let's say 10-year government bonds, drifts out, that will have an impact on what happens to funding costs. I think guys who can lock in 7 to 10-year debt at the moment at these sort of levels, though, should be doing it as much as they can. I think it's very attractive at the moment. I do think that debt funding costs will drift out as 10-year government bonds drift out. When that will happen, who knows? But you would say over the next 3 to 5 years, that should happen at some stage.
Jamie,
but there's still quite a big buffer between where cap rates are and lending rates are.
Mm-hmm. Jamie, we've spoken a lot about the United States at the moment, and I would concur. I think it's a decent market, and I think there's some decent valuations to be had there. But let's just look across the pond. Let's go into Europe and potentially even further out, maybe into Asia. What are some of the opportunities that you guys are seeing there? Is it a similar type situation to what we're seeing in the US?
Yes, no. Well, let me just talk to. I think let's just, if we start with the UK, I think London is in a very different position to the rest of the UK. Growth potential in London and pricing on assets has been very strong over the last 2-3 years. There's big appetite for London as a safe haven, specifically actually from Asia and more recently from European countries who are trying to have safe investments. So the London property market has been very hot. From a listed perspective, often the pricing is quite fine. So it's, you need to be doing some reasonably good growth to make the pricing attractive. We still see the London specialists as reasonably priced. And I think going forward, fundamentals are pretty good there. In Europe, the market is weak, and there's no doubt about it. And I think in those markets, you really want to stick to the quality assets and quality management teams.
Isn't this not the time,
classic examples of
Jamie, to be getting exposure to Europe then?
From a listed property perspective, it's actually run quite hard over the last 6 months. And we feel for the risks that you're taking, there's potentially other better investments elsewhere. Europe, you really got to focus very hard on what management can do, what their track record's like, what the quality of assets in those companies' portfolios. The good quality stuff in Europe is going to the divergence between that and secondary stuff is just going to get wider and wider. More recently, Europe has been weak over the last 2-3 months. We have taken that opportunity to increase. We have been underweight Europe since probably towards the end of last year, and we've started to start buying opportunistically in Europe a little bit now. But fundamentally, it's quite weak. The markets are definitely quite weak. In Asia, Hong Kong is really, really strong. The Hong Kong retail sales numbers came out again. They're around about 15% year on year for January and February. Those, as an owner of retail property, if your tenants are doing 15% growth in their turnover each year, you can capture that when you re-sign leases with them. So that, it's a hugely strong market. Pricing, obviously, if you look at that table earlier, how strong Hong Kong was last year, a lot of that has been captured in the price of these companies. Mm-hmm. But fundamentally, it's a very strong market, as is Singapore. On the flip side, I think Australia is not fundamentally that strong, but pricing is reasonably attractive. Your initial yields that you can buy Australian listed property stocks at are very attractive. Mm-hmm. Japan has obviously run very hard in the last 2 months, given what the Bank of Japan is doing there. To be honest, we're not quite sure that being able to attain a 2% inflation rate over the long term, if they're going to be able to do it. And secondly, if you're able to do that, what happens to your 10-year government bond in Japan? So does your required rate of return for those stocks go up? Theoretically it should. You can't sit in a 2% inflation environment with your 10-year government bond sitting around 50 bips forever. Yeah. So there's a lot of momentum there, and you must be mindful of that. And I think pricing on direct assets, cap rates may come in a little bit, but sustainability of that over the long term, I think, is something.